Good afternoon, everybody. My name is Patrick Ganley, and I'm here with Angus Geddes today. Angus, how are you?
Yeah, good. Thank you, Patrick.
We look forward to having a nice presentation today. There's a lot of stuff that's been going on in the markets, and I think we've got a lot of nice stuff to cover, Angus, for the members. I think it's been a pretty eventful couple of weeks. So I think before we get into the presentation, I just want to cover some housekeeping items that we just have to go through. The presentation today is for general advice only. Any information we provide or recommendations or content we speak about today is not for the specific investment objectives of anybody. You need to consult with your financial advisor or planner before acting on any of the advice that we talk about today. And please note, past performance is no indicator of future returns. So that will take us into the first slide. Here we've got comments and questions. So at the end of the presentation, you can ask any time throughout the presentation, and we'll endeavor to answer the questions, as many as possible. You can see the arrow here where you can fill your question in and they'll come across to us. If you can't hear the presentation, you're having any technical difficulties, our 1-300 number is published at the bottom here, 1-300-88-11-77. Please give us a call and one of our staff will help you fix up the presentation so the audio is okay. So we'll start off that profits market outlook and update on the macro side. Angus, we're going to come over to you. NASDAQ 100, it's still in an uptrend, but test the primary trend line support. We've seen quite a bit of activity in the NASDAQ, and I know you've been talking quite a bit about this in relation to the impact of this with the 10-year bond yields rising.
Yeah, look, I think we saw the US indices hit highs in July, and they've since corrected. We saw some selling coming through in August and into September with some of the mega cap tech stocks reacting to those higher bond yields. Now there's been no downside technical break yet in the NASDAQ 100, but we are getting to I guess the pointy end of a converging triangle. So in technical parlance, essentially what that means is that we're getting close to the NASDAQ 100 either breaking out on the top side and continuing the rally that's been underway since those December lows last year, or breaking below the primary uptrend support line and perhaps sustaining a deeper correction towards the 13,200 level. And I think, if the US stock market were to correct, it's going to be a correction. It's probably going to be accentuated in those tech stocks with the big valuations. Just as we've seen Apple, come off the boil this week. Bit of disappointment, around the iPhone. Clearly, their sales are probably not going to be quite as good as what the market was hoping for in China. I think we could sort of see a bit of that with some of these big cap tech names, which have had huge rallies for most of this year. But I guess the wild card really is going to be what those bond yields do, and if the bond yield continues to track up on the US 10-year. So yeah, certainly we're getting down to the pointy end of business, I guess, as it relates to this rally that's been underway, and we'll find out soon enough which way the NASDAQ 100 is going to break, whether it's to the top side or whether it's to the bottom side.
What surprised you the most about this rally, Angus, with the NASDAQ? Is there anything that stands out?
Look, I think the extent of it, from if you turn the clock back to December, most people, including us, thought that the world was going to be, and the United States was going to be having a very difficult problem and issues with the record pace of rate hikes from the Federal Reserve, and there hasn't been, up until now, we haven't really seen any reaction from the US consumer. The labor market's hung in there. The stock market was pricing in a big drop in earnings, which didn't materialize. And although we haven't had a lot of earnings growth, we've seen this multiple expansion coming through, particularly in those tech stocks, because of the fact that earnings have held in there. So I think that's been the biggest surprise, and the fact that the Nasdaq, the tech stocks have led the rally with one of the biggest gains this year, and that's probably, I think that's probably surprised a lot of people.
Okay, now as we move on to the S&P 500, this is an interesting chart, Angus. What are you seeing here?
Look, it's similar to the Nasdaq 100. We're sort of seeing that primary uptrend looking to be tested, I think, as we head into October. Similar reasons as the Nasdaq 100. The fact that 24-25% of the S&P 500 is made up of the Magnificent Seven. There's a lot of mega cap tech stocks that really make up the bulk of that index now. And it's the same story. If those bond yields continue to rise, I think we're going to see valuations pressured. I guess the other point to make is whilst the market kind of didn't react to the inflation data last night, which came in line with estimates, I think data prints out on the US economy, particularly around how the consumer's faring and how the labour market's going, are going to take on a heightened sensitivity at this point in the stock market cycle. And the retail sales numbers, which will be out tomorrow, will be closely scrutinised. A better than expected retail sales number, that might be the cue that the Nasdaq 100 and the S&P 500 need to reassert to the top side and keep this big rally that's been underway since those December lows going. But conversely, a disappointing retail sales number, perhaps a hawkish sentiment at next week's FOMC, although I don't think they're going to raise interest rates. That could damage sentiment. So we just got to bear in mind that we haven't really had a decent setback, and I'm sort of thinking that the Nasdaq 100's got more downside risk in a correction. If we put that previous chart up, if we just go back one slide, we're looking at probably a drop, a correction that could take that index down to 13,200, which would represent a 20% retracement from the top, or a 50% retracement of the entire move from those December lows. If we go back to the S&P 500, given that there's a lot of older economy stocks that also make up that index, and given that a lot of stocks have already been knocked around this year, such as the banks, I don't think the pullback will be quite as great. In fact, I'd probably only be looking for sort of 250 points on the downside, with that 4,200 support level looking quite formidable. So from top to bottom, we're looking at around 10%.
Isn't really a big drop, Angus, don't you think? I mean, 10% is probably livable, given how hard the index has run.
Yeah, look, I think I could be wrong about this. As we were talking about before, the retail sales numbers come out and they're solid. We could see those US indices, rip to the top side. There's some well-known economic stock market forecasters predicting 5,000 by the end of the year. But I'm thinking between now and then, I think there is a correction coming. We haven't had one, and we're looking at potentially a catalyst here. I think it's going to be the US 10-year bond, and quite clearly, this chart is showing the 10-year breaking out on the top side. There's a lot of well-known market strategists that are bullish on bonds, You know, Morgan Stanley, JP Morgan, although they've become a bit more neutral, but I just don't see it technically. This technical setup favors upside extension in the US 10-year, and I'm sort of seeing the US 10-year moving up into a higher range, but between 4.3, 4.4, and 4.7%, and I think that'll be enough to instigate a correction in the S&P 500 and certainly then the Nasdaq 100. And as we were saying before, the S&P 500, it's got corrective downside potential of 10%, and probably close to 20% for the Nasdaq 100.
And you think this point is pointing to possibly higher interest rates coming as well?
I do see that. And look, hey, it's not about. I don't think the Fed are going to raise rates next week. I'm not even really seeing them raise rates again in November. But given that inflation print was still pretty elevated, and given the inflationary pressures that are now coming through from gasoline prices, which we haven't seen for 12 months, inflation and the services inflation, wages are proving to be quite sticky. I think the messaging is going to change, and that they're going to keep them high for longer than what the market's currently looking for. Consensus expects the Fed to be cutting by the second quarter of next year, between April and June. So, all it would really take to trigger another leg higher in these 10-year bond yields and the 30-year bond yields as well, for that matter, would just be more hawkish rhetoric from the Fed. So at least that's how I'm sort of seeing it at the moment.
And the petrol prices and oil are a bit of an issue with those inflation and CPI numbers, aren't they, at the moment?
Well, they are. The consumers are paying, $3.75, $3.80 US for a gallon, and we know what's going to happen if gas prices go above $4 a gallon. It then becomes a bit of a media firestorm, and that feeds on itself. And this is, we haven't had this as part of we haven't had rising gasoline prices as being part of the inflation narrative for quite some time. It's actually been part of the falling inflation narrative. Now, we've got a chart there of the oil price. Yeah, let's put this up. So look, I've been sort of watching crude pipe prices for a while, Pat, and after consolidating within that big range, we saw WTI Crude break out above that big resistance level at sort of 83, and it's extended, pretty much exactly how we thought it would, up towards $90, and I think it's going into the mid 90s. All the conditions are now sort of in place. We haven't seen demand fall off a cliff. Demand's actually remained very strong. China's been importing record amounts. Their airline industry, domestic airlines industry, is back to higher levels than it was before the pandemic. So demand's not going down. And, on the other side of it, we've got some of the major producers, such as Saudi Arabia, implementing production cuts, which will extend right through to the end of this year. So they clearly want to get oil prices back up. America used to be a very quick response producer, where they could add a lot of capacity quite quickly, particularly in shale. Shale oil from the Permian Basin. Now that's just not coming back in the same way that it has in previous cycles. So, I think pricing power has shifted back to OPEC, and whilst I don't think they're going to put oil back up to $110, $120 a barrel, I think that it's entirely plausible that we could see oil back in the mid 90s. In which case, you know, Pat, you're an American, probably means that Americans are going to be paying $4.50 a gallon.
Well, this is a big thing. You know, when I talk to my family and friends over in the States, you know, they're all talking about these gas prices, and not only gas prices, but we're coming into the North American winter, which you know isn't going to help either. And I think I was just going to say, Angus, this is a thematic that you've been pretty strong on, which is the energy, oil, energy, the energy stocks, and uranium. And it seems to be that that thematic is playing out quite well. And I know you've been pretty well positioned with that in all the wealth management products that we offer the portfolios. And that thematic has seemed to do quite well recently.
Look, the commodities have done well, and I think the soft ag complex has been a bit disappointing. You know, like we haven't really seen the grains perform that well, although a lot of those soft ag commodities such as sugar, coffee, you know, they're all at record highs or near record decade highs. So I do think that, you know, climate change is real. You know, we've got the El Nino happening in the Pacific, you know, around the Pacific. It's going to impact Australia this year, and you know, perhaps we might even have another drought. And I think that's all going to put upward pressure on food prices. I also think that the energy complex is headed higher. You know, we've seen coal prices come off, we've seen oil come off this year, but they're now all reasserting to the top side, which has to be inflationary, right? And that second wave of inflation that you know, that I've been writing about for this year, it seems to be playing out now. Look, part of our energy strategy is also in uranium, and you know, I think the idea really behind uranium is that spot prices have had this big decade-long period of convalescence. We've seen a big, powerful breakup out of the range, and I think what this is really telling us is that renewables are really important for the world in terms of, you know, getting carbon emissions down, navigating climate change, transitioning to cleaner energy. But the simple fact is that renewables are not going to be able to, you know, provide everything to the base to a country's base load power grid, and that nuclear energy is making a comeback. You know, there's 60 modular reactors being constructed and underway at the moment. You know, China's certainly embracing the nuclear option, and you know, if we're not going to burn coal, and solar and, you know, wind power are not going to be able to you know, make up all of our power requirements, then nuclear has to be an option. And I think that's what's sort of playing out now with the breakout in uranium spot prices, and a lot of the uranium stocks following the higher uranium spot prices in the last couple of weeks are moving higher. So I think that really points to a big re-rating that's coming for the uranium mining sector.
And you're still happy with your current positions with your uranium stocks, the ETF and Paladin?
Yeah, I think the ETF really nails it in terms of providing diversification across the world's major uranium producers, of which, you know, Paladin is in that basket. And then, but closer to home, you know, in terms of Australia, we like Paladin. It's restarting the Langer Heinrich mine over in Namibia, which should be online in the first quarter of next year. They did a broker presentation to Bell Potter yesterday. The stock's up sort of 7% today. So yeah, I think there's some value to be had there, and it's not too late to catch the train, the uranium train that's about to leave the station.
And I know in the daily, your daily this morning, Angus, you spoke about the US CPI number, gas prices becoming a problem, and you ran this graphic here, which is quite interesting, quite telling. And it does seem to be those gas prices are being problematic with all of this at the moment.
Yeah, well, we can see from this chart that look, the good news is that the US CPI is trending down. That is the good news, and you know, the inflation print came in pretty much where the market wanted it to come in. But you know, I think it's going to be sticky. It's going to be very sticky trying to get it back to target. You know, and there's risk that it could actually start climbing again, particularly if we see commodity prices reasserting to the top side, if we see food prices rise over the coming 6 months due to, you know, drought, flooding, climate change, etc. And as we see the oil price move back up into the mid-90s.
And I know you wrote a little bit today about the real estate companies. Quite a few of the companies got hit pretty hard yesterday. Fears of interest rates may be higher for longer, but also that could have an impact on inflation as well. All of this talk of building, shortage of labor, shortage of supply, especially here in Australia, but it could be a theme that we could see around the world. What do you think about that at the time
Well,
being?
in terms of Australia, I definitely don't envy the job that the Prime Minister's got. I mean, you know, there's a chronic housing shortage in Australia. It's a housing crisis. We've seen rents skyrocket. You know, clearly the government can't sit there and do nothing. But, you know, like the question then becomes, what do you do? What do you do? You know, and I guess the response in terms of allocating government money, which is probably the only choice that they've got at this point in time, to build a lot of extra housing. I mean, the flip side's going to be, you know, we've had industry commentators, industry insiders say that that's going to force up inflation. There's a shortage of workers already in the construction industry. It's going to lead to a lot of inflation. You know, there's capacity shortages. So yeah, it's not an easy one to solve. And you know, the bottom line is that immigration's been high in this country, and we haven't kept up with, you know, with housing. And I think, you know, also the demand for investment property's gone down. You know, people have been scared by rising interest rates. So you know, it's not an easy one to solve. The United States has got a similar problem, Pat. You know, after the GFC, the construction industry went through one of the hardest slumps of all time in US history, and nothing got built. You know, there were all those mortgagee sales back in 2010, 2009, 2011. They cleared the backlog, but they cleared the backlog. But the problem is, again, like Australia, they haven't kept pace with construction, and now there's a chronic shortage. So yeah.
And you spoke a little bit about Zillow today. I know it's a stock you've had your eye on a bit, and as you said today, it's starting to look a bit interesting.
Look, I think Zillow is really good because, you know, it's the REA, the realestate.com.au of the United States. It's the real estate portal, and you know, they're in pole position. The stock's well down from its record highs. You know, they've rationalized their business, but more importantly, they've really sort of cemented their grasp in terms of their market share in the US real estate market. And, you know, it's the #1 portal. And I think, you know, we're getting to a point where, you know, that stock's looking pretty interesting. I mean, we've held it for a while in our SMAs, and it's recovered, you know, nicely from those lows of last year. And yeah, it's certainly a stock that I think is looking interesting once we get through, you know, a possible correction, you know, seasonal correction as we sort of head into October.
And the global airlines look a bit interesting at the moment. They seem to be breaking down for a number of reasons. One probably being the rising fuel costs. We've seen quite a bit of action with the airlines recently.
Yeah, look, I think this is quite a telling chart. You know, just as oil's breaking out, jet fuel prices are also going up, and it's impacting the airlines. And you know, the airlines are going to probably have to start putting ticket prices up to protect their margins as it relates to high jet fuel prices, and you know that's going to feed directly into inflation. So you know we can see the global JETS ETF, which is an ETF that comprises all the major global airlines, all you know, they're all breaking down. You know, the inevitable question in relation to this chart is Qantas, and you know I think the answer to that question is Qantas has got real pricing power, as we know. They've got you know, it's not a monopoly, but it's not far from one. It's an oligopoly, certainly. So they'll probably weather the storm a lot better than most other airlines, given the size of their market share in their home market. But yeah, I think for a lot of those global airlines, it's tough times, or tougher times with rising jet fuel costs.
We had a question, and we're going to insert another chart. We had a question about the Aussie CPI numbers. So we've put this in, and a couple of the members have been asking about our comment on this, Angus.
Yeah, I'm struggling to know what this chart is actually. Is it the CPI, or it's a CPI index? Anyway, look, again, like the US, you know, we had a positive downward trend last month in inflation. All eyes are going to be on the CPI for Thursday. And of course, you know, what everyone wants to see is another print lower. But, you know, it's not as, the downward trend in inflation is not as clear cut as what it was, given this sort of upward pressure that we're seeing in the commodities, notably oil. You know, we're now back to paying $2 plus for a liter of petrol. And also, let's not forget, you know, the Australian exchange rate's quite low at the moment, which is also, you know, putting upward pressure on food prices. So, yeah, I don't have a good feel for what the actual number is going to be on Thursday, but one thing I am quite sure of, and that is this sharp fall could begin to arrest itself, and you know I think we're going to start to see the pace of declines really begin to flatten out, because inflation really is sticky. It's proving to be a very sticky problem to resolve.
The old Goldilocks economy, Angus. We haven't really heard those words out of the U.S. for quite a long period of time. It's probably back in 2007. There was a lot of talk about the Goldilocks economy. We've had a question from a member about that. What are your views on that?
Well, there has been a lot of talk about the Goldilocks being back. You know, bad news is construed as good news. And, you know, for a while, a slight rise in the unemployment rate was construed as positive, softening retail sales was construed as positive. But now I think, you know, and this goes back to what we were talking about earlier, I think data prints surrounding the strength of the US economy take on a heightened significance at this point in the cycle. And for example, if we got a bad retail sales number tomorrow for the US, I think the market would be off, because people would start saying, well, the market would start sort of pricing in that, well, maybe it's not going to be a soft landing, maybe it's going to be a harder landing than what everyone expects. The equity market has baked in a soft landing. So, yeah, I think, you know, the economic data is going to be closely scrutinized over coming months. to see whether this whole soft landing narrative, which the market is looking forward to, is going to hold together.
And
So
with China,
Goldilocks, to answer the question, I think the Goldilocks sort of scenario where bad news is good news, I think that is yesterday's narrative, and bad news is now going to be construed as bad news.
we've had a couple questions about China and talk about the Chinese tech stocks. You still remain pretty positive and focused on that sector, don't you, at the moment?
Look, it's a hard one. I mean, we're battling at the moment. We're battling very negative sentiment. You can't put on the business news without listening to negative stories about China. The property market falling apart and the developers going bust, and it's pretty gloomy. It's pretty gloomy. But what we are seeing is the downward momentum dissipate in some of those major benchmarks. The CSI 300 is no longer going down as much. The Hang Seng is no longer going down as much. And in fact, they haven't actually taken out their October lows from last year. I think that could have been the final bottom. So it sort of says to me that, from a contrarian perspective, that those benchmarks are no longer reacting to bad news, and that's a good thing. I guess the second point to make about it is that while the Chinese government haven't fired the bazooka, there's not a week that goes by that they don't do something. And these incremental measures are beginning to add up. The third point to make about it is valuations are extremely cheap. You can buy some of those mega cap tech stocks on multiples of 10 times. And, given their earnings reports were pretty solid, a lot of them had very strong earnings growth when they all reported their June quarterly earnings a few weeks ago. Things are not that bad. And the other point to make is we haven't actually seen the iron ore price roll over. I mean, if China's economy was really going to seed, you'd expect that the iron ore price to be below $100 a barrel. You'd expect the oil price to be back in the 60s, and we haven't seen that. So, prima facie, we haven't seen copper. We haven't seen copper fall over. So, I mean, looking at some of these commodity prices, maybe, China's actually sort of muddling its way through the bottom now, and that, better days lie ahead for the stock market. And as always, the technical price action confirms everything. But I do think it's getting very interesting. And whilst I wouldn't be in boots and all at the moment in terms of China's stock market, now's the time to be looking at it closely for signs of an inflection, and perhaps establishing beachhead positions, which we've certainly done in the Global Contrarian Fund and the Global High Conviction Exchange Traded Fund.
If we just touch on gold for a second, it seems gold's at an all-time high from a production standpoint. What do you think this means for the gold price and the gold sector going forward?
Well, I've always maintained, Pat, in relation to the gold, the gold price, that the US dollar, getting the direction of the US dollar is key. And at the moment, we've still got US interest rate differentials blowing out in favor of the US, which has put upward pressure on the US dollar. But look, I have sort of noticed that the US dollar is beginning to show signs of fatigue, and it's not so much rolling over, but it's really struggling to push through sort of 105 on the dollar index. It seems to me that other countries are going to have to lift their interest rates further, and that could put upward pressure on, or downward pressure, I should say, on the greenback. The other point is Japan. They're normalizing their monetary policy, which means higher interest rates in Japan, and that means a higher yen and a lower US dollar. So yeah, I've sort of got a bit of a neutral view on it, on where the dollar goes and where gold goes in the very near term. But looking at over the medium term, I think the US dollar is going to come under pressure, and I think it's going to provide a powerful tailwind for gold and for precious metal equities. The one point to really hammer home though is that this year has really been the first really big year that we've seen concerted buying in the spot gold market by global central banks. And this is a real trend. It's no longer just sort of being driven by investors and jewelry demand. We're actually seeing central bank buying on quite a large scale. And this is not going to slow down. This trend is going to be, it's going to be there for a number of years. And the bottom line is central banks are no longer prepared just to hold all their FX reserves in US dollars and US Treasury bonds. They're going to diversify, and gold is one of the asset classes that's going to benefit from that. I mean, the Chinese bought 23 tons of gold in July. I'm sure they would have been quite active in August. So it's hard to see a lot of downside, but I can see where the upside's coming from once the US dollar starts to inflect to the downside.
So if we just circle back to Japan, I know you touched on the Japanese market, and it's something that you've been focused on quite a bit with the Japanese banks. Or are you still positive in that area at the moment?
Still very positive on those Japanese banks. I think, and the Japanese stock market. I mean, it's the one country in the world really that has benefited from inflation after 3 decades of stagnation and deflation, and it's really jump-starting the economy. And as it relates to those Japanese banks, I mean, they were having to try and make money when interest rates were at 0.1 a decade ago. So it's been fantastic to watch them all get re-rated, and as their net interest margins expand. And I think there's further to go. The Japanese 10-year is currently trading at about 0.7. I can see it hitting 1.5% in the next 6 to 9 months as the Bank of Japan normalizes their monetary policy and allow longer dated interest rates to rise. And given that the price to book ratio for a lot of those Japanese banks is still 0.7 times, it's, as a sector, it's still looking pretty cheap compared to the rest of the world. And the last place that's going to have a problem with the housing market is Japan at this point in the cycle, given that Japanese house prices really haven't done much for 20 or 30 odd years. So I think these are really good days ahead for the Japanese banks, and we're on board with that. It's our largest portfolio asset allocation, and the global contrarian fund and the global high conviction ETF, and it's going to remain so for the foreseeable future. I think we're going to get more outperformance from that sector.
Okay, and as we look into next week, are there any key things you're looking at that may drive markets over the medium to long term here? We've got quite a bit of data coming out. Are there a couple key things that you're looking at the moment?
Look, I think we've got the FOMC meeting. I don't think there's going to be a change. The swap markets are pricing in a 93% probability that the Fed will leave rates unchanged. I don't think the Fed will want to upset the apple cart. But I think they are going to talk about sticky inflation and talking about the duration that they're going to have to keep rates high for to really squeeze inflation out of the system. And the market may not like that. So that's one thing I'm going to keep my eye on. We've got the retail sales tomorrow, which is an important one. It'll provide a window into how the US consumer's tracking. A good print could see the stock market rip to the top side, but a poor print could see some of these indices, these US benchmarks, begin to break down and undergo a decent correction into October. So that's what I'm going to be focused on. And also the oil price, keep an eye on that. As we were talking about before, it looks like it's headed back into the mid-90s. And that's obviously driving a lot of sort of inflationary fear and rhetoric in the business media. I think that will pick up the higher the oil price goes.
I think an interesting image, and gloves are off in the daily today. What are your thoughts on that? I mean, what were you thinking when you came up with that today?
Oh, look, I was having a bit of fun with that, Pat. I just thought it was very funny that Bill Gross, who, the years and decades he was referred to as the Bond King, and now that he's retired, because Bill would be in his 80s, everyone's now calling Jeffrey Grunlash the Bond King, and so it was quite funny just watching the pair of them have a bit of a sparring match in the media, and about who's the Bond King. It's never ceases to give me a chuckle when these billionaires with huge egos start throwing mud at each other. It's quite funny, and I just threw that link in to the Bill Ackman Carl Icahn interview. It's an absolute classic. If you can find it on YouTube, I'd encourage everyone to watch the longer play session. But it was really interesting. It was hysterical because Bill Ackman was giving an interview on CNBC, and Carl Icahn was watching CNBC, and he saw it. This is about a year or so ago. Carl had a big long position in a company, Herbalife, and Bill Ackman had a big short position in Herbalife. So it was these, huge egos, these billionaires battling it out. Anyway, Carl rang CNBC and they patched him through, and it was all live. And he took Bill on, and it was almost like a debate. And I'll let all our members click on that interview and watch it. But it was quite amusing.
You mentioned you were speaking with your Hong Kong brokers yesterday. What were they trying to say at that point?
It's always interesting touching base with the guys when they come down from Hong Kong, just to get an insight with how Hong Kong's going, what's happening at the street level. Are things really that depressed up there? We've got the Hang Seng sort of wallowing at decade lows. Are things really that bad? And the short answer was no. People are spending money, restaurants are full, house prices haven't rolled over, people are still buying, investing in property. Things are not that bad. That was the message that I was getting. So, you tie that up with what the Chinese government are doing on the stimulus side, and maybe just looking at that stock market, maybe we're nearing an important inflection point.
Okay, well, thanks for that. Well, we'd like to thank all members for their time today. We hope you got some value out of the presentation. Angus, thank you. It's always a pleasure to spend some time with you on these webinars and get your views on what you see in the market. Is there anything else you'd like to say to the members before we sign off?
No, Pat, thanks for doing a good job on the questions today and moderating, and just want to thank everyone for listening in today, and we look forward to joining you same time, same bat channel next Thursday. Bye for now.
Thank you. Bye for now.